Good afternoon, everybody, and welcome to today's Stock Market Brief Show. It's April 24th, and we're going to talk about the big moves that have been happening in the market. It's okay if you missed it. It's okay if you got FOMO, or if you're wondering what you should do because you actually did catch it. We're going to talk about some very important levels from a risk management standpoint. We're going to dive deep into the S&P 500. We're going to look at some moving averages, some volume-weighted average prices. We're going to dive into expected moves. We're going to dive into the current market conditions, the most useful tools that I use to help navigate this volatility. We're going to dive into some signal charts as well. It gives us a good idea from short-term oversold, overbought, yada, yada. These episodes are brought to you in partnership with Interactive Brokers, so make sure you check out the link in the pinned comment or the description. Even if you have Interactive Brokers, check them out. Take a look at the campus. If you don't have them, make sure that you look at the campus because they got all types of cool resources, including courses from beginner to advanced. And a big thanks and shout out to my Patreon group. For those that are interested, I still haven't made a video on everything that I offer. It's $9 a month. And let me just tell you this, it's a very, very good deal for what's out there. Recently, it was brought to my attention that there's other paid services that charge $60+ a month. And there's a couple of them that are in my channel that take and pull from my content, and I've been taking it. So I was a little bit PO'd about that and seeing that. And so I've had to start to watermark all my content. But for $9 a month, you get the daily, weekly, monthly, quarterly expected moves. You get the daily zones document, which is a cool indicator called bridge bands, and I give this cool fractal view of everything and so much more. I give my weekly watch list update, the tight list stocks from the watch list that are contracting. You have the full access to the Tradie Ticks suite that they host on their Discord servers, so you can type in all these commands in the Tradie Ticks area, and you can get all types of research, all types of data from option bots to market net flow, which is something that I share very frequently. All types of stuff. It's $9 a month. So if you like it, awesome. It was $9. If you don't like it, well, congratulations. You lost $9. Not a big deal. I'll also update you today on my standings within the United States Investing Championship. We're going to start today by looking at the S&P 500 out of the gates. Okay, so first and foremost, we've been seeing a lot of volatility. It's been crazy. We're down. We went to bear market territory. We're out of bear market territory. We had a big, huge, crazy, biggest day in history over here type of short squeeze. And now we're kind of coming back up into this level over here. If you remember back over here in this time, we were talking about this range that we've been kind of just building all this open interest in. And once we broke the range, we talked about the potential of a bull trap, which happened. But when we actually substantially break the range, we can see an increase in volatility, whether that be a squeeze to the downside, squeeze to the upside. I don't really know, but now we do, obviously, in hindsight. Now, a lot of people have been calling for the bottom or a bottom. This right here is a bottom. We don't know if this is the bottom until, well, I guess in hindsight, when we take out these highs, if that was actually going to be the case. Now, if you're in the move and you've been catching it to the upside, awesome. If you got capitulated out, we'll start to look at some of those key levels and some stuff that I pay attention to in order to kind of navigate this stuff. I rarely show, I do like to show my performance because I do talk a lot about markets, and I'm pretty positive I'm one of the very few YouTube people out here that actually get their performance verified to show. It's funny because when I show it, either if I'm doing good, it's considered bragging, but if I'm doing bad, it's considered because I suck. But so the most recent standing in the United States Investing Championship, I'm up 9.6% year to date. Now I'm up 17.44%. That's as of April 23rd. I should be a little bit higher than that right now. I'm a little heavy cash handed in the current moment on performance right now because I did sell into some of this market bump up, but this is with the S&P 500 down 8%, the Dow Jones down around 9%. So it's doing pretty good as far as navigating these kind of markets. Okay, so I want to zoom in here to the S&P 500 and kind of map out some of these key levels. We've been talking about a few things. We've been talking about gamma flip lines. We've been talking about 5-day moving averages. We've been talking about follow-through days. Well, today we saw a very, very nice move following through on the very first official follow-through day over here. A follow-through day, for those that don't know, is based off the work from William O'Neill. You look for a low, and then you start to count the attempted rally. You want a day that's 1.2. I mean, there's orthodox ways of looking at this, 1.2 to 1.5% higher with volume, up with volume higher than the prior trading day. So, and you want that through days 4+. for the most part. So this was day 1, day 2, day 3, day 4, day 5, day 6, day 7, day 8, day 9, and bam, on day 10, we had our first follow through day. And this here is a very important day to kind of hone in on. And I'll explain that more by looking at some anchored volume weighted average prices and some averages and so forth. But this low, this right here, 10th day of the attempted rally, was an important one. Then even this day would be considered technically, I guess, a follow-through day, albeit that it closed near the low of the trading session, and you typically wanted to have it close a little higher. But regardless to say, yeah, it had higher volume than the prior day, and it was a massive up day. So you start to see follow-through days stack on each other. That's a positive sign. Overall, though, where are we? Well, we're kind of pulling back into around the high from this day over here when I already am slipping my mind of what was said, but it was a Trump tweet, or Trump said something, and it made the market rally incredibly hard. Okay, so I want to continue on and kind of look at some of these key levels. Actually, you know what? I guess I'll show this really quick. This is a trend kind of model that I put together. I used ChatGPT to help me code it. And it's looking at multiple time frames. It's looking at rate of change and momentum. And it gave actually the insight the day before December 18th of last year that it was going to be a sell signal. And sure enough, it's still on that sell signal right now. But you can see even the last correction down here, which was 10%, this was roughly a correction, about 10% here going into August. It caught most of those moves. And I was kind of just keeping an eye on it to see if this would eventually turn green in the near future. And it just hasn't done so yet, as this market's still kind of trying to find its legs. Now, if we take a look at the anchored volume weighted average price from the last correction, and it comes all the way up into here, what you'll notice here is it's actually by that follow through day. So I want to zoom in here and kind of walk you through a couple more anchored volume weighted average prices that I'm honing in on. So first and foremost, we got the green one up here and the red one down here. And what you'll notice is this is the all-time high anchored volume weighted average price, and price has been rejected at here. So it had acted as resistance right here. And now price is pretty much at that level as it stands right now, especially after hours since Google reported, and there was also some news around Amazon there too as well. So we'll see if that holds as a potential level of resistance. And then this down here would be that potential level of support. So if price kind of doodles in around here and bases out, it could make for a good squeeze, whether that's to the upside or downside. But as it stands right now, if you're wondering where the risk levels might be, you can see that this VWAP from that correction low is kind of just slightly above this VWAP. And that's right where the follow through day is. So my thoughts here is, simply put, you don't really want to start taking out the low of this follow through day. That right there would be not a great sign to see. So right now, as we've seen this big move, what I'd like to see is price to consolidate, maybe go up a little bit more, touch into the white line. That's the year-to-date volume weighted average price, held as support and also acted as an area of resistance here. So if it can doodle around in these areas, but still remain to hold these levels, that would be an important sign for me in the market. But we'll dive more into some other stuff. You can see over here when I overlaid the volume, you can see that follow through day. I wanted to take another step and add in some moving averages. It gets a little messy now, but I'm overlaying the 5, 10, and 20 moving averages. This is known as a 5, 10, 20 timer, and you want the 5 and 10 period moving averages stacked on one another and above the 20, and it's not actually quite there yet. You can see it a little bit cleaner here where we have the blue, red, and green stacked onto each other. When they all cross over, it leads into a buy signal. Right over here, it did it again after crossing through to a bearish signal. And then over here, you saw some chop. And then this was the main crossover over here that's led us into this entire sell-off. And now, well, what are we seeing? Well, we're back above the 20-day. The 5-day is now increasing. The 5-day and the 10-day are starting to turn around, and price is above it. So if we can hold up in these ranges, these can start to pull up. The 20-day can start to flatten out and turn up, and that could be a good sign for the markets from just a moving average perspective. However, if we do start to move up higher, I do want to call out that there's other averages, the bigger ones, which is the 50 and the 200. And the 50-day is still currently declining at this current moment, and the 200-day has begun its descent as well, albeit it's rather neutral. And those are the bigger dogs, so to speak, as far as averages go in these markets. Over here, you can see this red shaded area is bear market territory. We came down to bear market territory, and we've seen a big, massive bounce from that level. And if we close the month off like this, I mean, this is the fairly large hammer candle. It showed that it was very, very bearish, but the bulls stepped in, which is a positive sign right now. The Qs, the same situation. We have this doji candle at the current moment. We still got time left in the month, but we dropped underneath the quarter to date expected move, the month to date expected move, and into bear market territory. And from that point, we bounced back up into and around the declining monthly 5 EMA. IWM, we're still in bear market territory, but we were well deep into bear market territory underneath the quarter date, underneath the month to date. In this red shaded area, we were really deep into that area, but we're kind of forming that somewhat of a hammer candle here, still below that monthly 5 EMA. And if you paid very close attention, you'll notice that the percent price oscillators have all been crossed over as bearish here too as well. And it could take a lot of time to recover those types of crossovers. Let's look at some of the expected moves. If we take a look at the SPY right now, this is looking at the year-to-date perspective. So we're looking at 2025 to start to where we currently are and all these orange lines on the screen, or is what the options market priced in as far as risk goes for the week. So every Friday at the close, I know what the expected risk is for the following week. This is based off of volatility, but more specifically implied volatility. For those that don't know, there's two types of volatility. You get realized vol, which is volatility that has happened in the past, and then implied vol, which is, in my opinion, one of the best, I don't really want to call it an indicator, but the best way to kind of handicap risk looking forward. So any asset that trades options would technically be able to do this. So I'm looking at the S&P 500. We tagged into the lower weekly, okay? And we shot, boom, right up to the upper weekly. So in last market brief, we talked about, hey, if we come up into these areas, that could be a potential area where I'd start scaling out again, which I just so happened to do. Okay, now we're currently still above that line. We're back above the quarter to date. We're back into the month to date expected moves there too as well. Going into tomorrow's trading session, we still see a large daily range of risk. So we can see us up here at about 556 to 554 to 556, and then beneath us down here at about 540 to 537. Now, typically, when you get outside of the weekly implied moves, it's likely to come back in and doodle around, especially after just a crazy move that we saw today. That was just a very strong bullish move. And you can even see down here where we came into it, we bounced right from those levels. So it's very common to see this. We just had Google report, and we see Amazon after hours getting some steam. So we'll see how that plays. But if price were to kind of doodle into these areas, this would just be a consolidation, and we'd still be above a 5-day moving average that's inclining. We're above this blue line. The blue line is the quarter to date / month to date. And we're above the week to date volume weighted average price here too. So yeah, if you're buying right here or up here in these areas for a first execution, you might have to deal with some consolidations and pullbacks. For me, I'm a little heavy-handed cash right now because I've been selling into this. So I am going to look for individual names that might be setting up still and not try to chase moves that have already been made in these markets. So for example, if I want to get more exposure into the S&P 500, I want to do so when it starts to pull back a little bit. Man, my thing's going everywhere. When it starts to pull back a little bit and then start to show some strength. So a move like this or like this, just very similar to how this happened right here. This day, people were all bearish about it, but it came into the upper weekly. It came down very controlled, and then bam, we saw the big breakout today and continuation. I want to show some of the expected moves for the Mag 7 names, just so you have an idea of where they stand within their weekly implied moves. Apple is currently outside of it, above a rising 5-day and above the week to date. Microsoft got a very nice squeeze today outside of the upper weekly implied move. So this looks like a move that probably needs to digest here a little bit. If you take a look at Google, Google is not there yet, but obviously they reported after the bell. So they're actually significantly outside of that in this current moment. Amazon also was up after the bell too. This got outside of its weekly. It pulled back in. It started turning it as support. Now this is interesting because when you break these weekly expected moves, like we saw over here, this is the market. They're saying basically for the week, what they said right over here on the close of business right over here, they said this is what we expect as risk, and they got very wrong. So what happens at that point? If they're really wrong, well, dynamic hedging kicks in. So now all of a sudden it acts as a flip and starts moving higher. So now is it going to come back in and digest with the rest of the market, or are we going to kind of remain up in these upper levels? It's yet to be seen, but I definitely would not consider chasing these strong moves right now. Tesla has not touched this weekly expected move yet. It's above a 5-day, and this one looked pretty nice, seeing some upper kind of lows here, higher lows, tight price action, and then we had a pretty good close with this. So perhaps tomorrow we can start to see if the market wants to continue to run, Tesla could be one to see try to go for that 270.41. Nvidia also still has an open range of risk. You can see that we came into the lower monthly implied move to start the week, but since that we've been trying to find our way back to the upper portions. Let's take a look at market conditions. As far as market conditions, I look at two things: where we stand, where the gamma flip line is, and the directions of the 5-day moving averages. And that's more shorter term perspective. And it also, for those that don't know on market conditions, okay, once again, I want to just reiterate this. This is not to, because people get this wrong all the time. They think that this is to predict markets. It's not to predict markets. It's to prepare you for what potentially could happen. It's to look at potential paths that these markets can move, and market conditions. If you have a strategy A and it works in a positive market condition, and all of a sudden you don't have any way to gauge if market conditions are going to change, that strategy A might work poorly in a negative market condition environment or a bearish market condition environment. So I always change my strategy when conditions change. And the conditions that I use are the flip line and the 5-day moving average. I add in some other elements, but that's the basis of it. Okay, so the direction of the 5-day moving average right now, it's been positive. It's been showing strength. We're inclining around the SPY Q, IWM, DIA, XBI, and semiconductor. So that's all a positive sign, albeit that we've kind of ran far and fast. And we have our year-to-date VWAPs not too far ahead of us. So if we get a strong move up into these areas, I look for the consolidations and I try to play from there. From a gamma perspective, 5,600 right now is the call wall, and that can act as a pin, or price can act as an area of resistance. So if price wants to continue to move, pay close to 5,600. If price wants to slip back off, 5,200 is the level that's been holding as our put wall, and that can act as a potential level of support. With the gamma flip line is roughly at about 5,600, which is in confluence with that call wall. It's slightly below it, but I'm just going to round it, okay? Because it's typically a zone. You'll get some services that'll say, hey, it's 5,550, it's 5,600, whatever. That's also in confluence with the all-time high anchored volume weighted average price, which, by the way, overnight in the S&P 500, we did come into these areas. We're about 50 points away, given the context of what happened after the bell with Alphabet reporting earnings, and then the Amazon news there too as well. So the gamma flip line, if we're starting to go positive, this is what I mean by, like, you don't want to underestimate the power houses that can start stepping into this market when these conditions change. What we've seen right now is very typical in negative gamma. When you're below a gamma flip line, what happens is you get selling into selling. You get buying into buying, liquidity dries up, volatility increases. We have been below the gamma flip line since February 21st. If I go to this chart of the S&P 500, February 21st was right here, right here this day. And once we went into negative gamma, what do you notice? All of a sudden, these small little bars turned into larger bars and larger bars. Liquidity dries up, volatility increases. Now, there's another nice display that I like to show you from February 21st, but all these little pockets over here, I've been keeping track of what the VIX does when we go into negative gamma. And you can see the gray shaded box is showing the times that we're under the flip line and when we get out of it. And each time it gives us a good heads up notice that, hey, there's the possibility that volatility can very well shoot off. So it saved my butt in August. It saved my butt this year too as well. It gave me this early warning sign, okay, amongst other things, and it basically stated that saying, hey, you really got to pay attention right now because something could be brewing, and something happened to brew. It could have been a little quick pop and drop, but it wasn't. And the conditions of the market told us this. Okay, so let's continue on. The things that I've been talking about here, do not underestimate their power, because this could get crazy. What we've seen was pretty crazy, but we still haven't really triggered any levels to see substantial real buying enter. So if I look at something like vol control funds, this is puked out. Vol control funds, they puked out. They help obviously contribute to the sell side in equities that we've been seeing. If you zoom out further and look at vol control positioning, this is like a 60% puke from its all-time highs over here. And the last time we were over here was in the 2022 bear market. Okay, so if we start to cross back above this gamma flip line, this could help stabilize these funds, the position of vol control funds. So that could be a very good sign for volatility to come off and potentially be buyers net of equities. The next thing is CTAs, commodity trading advisors. These, in pretty much every single way you can look now that we've been sharing on an up tape, down tape, sideways tape, flat tape, they become buyers. And you can see the Goldman Sachs, their CTA estimates or their projections of it. And pretty much in every condition, they become buyers. And right now, they have kind of stabilized, but they haven't yet. So if we start breaking, which I would estimate maybe 5,500 to 5,600, that zone in the S&P 500, these guys can turn on their engines and they could become big buyers in the market, which could really kind of shake up the whole crowd that says the low is not in. And that's the idea behind the pain trade that I've been talking about here these last few days, how the pain trade to me is actually not the market going to a new low. I think the pain trade is going to go flat from a year-to-date perspective. And the reason for that is because retail and passive investors, they've been buying as much as they can. And if they got triggered or flipped out over here as hedge funds, institutions have been net sellers, the painful move would be back to break even and them having to try to find their way back up into that area from a year-to-date basis. And if that is the case and you're FOMOing into it, who's to say that it can't roll over later? Now, I would prefer being where I'm at now for the market to roll over. That's what I would prefer because it would give us more opportunity to find better deals, better setups in these markets, but it hasn't happened yet. The follow-through day lets me know to start getting my feet back in the water. The direction of the 5-day moving average tells me the same thing. So yeah, it's not been super difficult to navigate, but it has been very volatile. So you got to kind of volatility adjust your positioning, so to speak. We'll continue on here and look at the VIX futures curve is another important aspect in all of this. And it still tells us that, hey, we still got problems here and now. So until we get above that flip line is when we start to see this change. I use the analogy of a marathon. If we're running a marathon, we're in the marathon right now. We're at miles 17, 18. We see the finish line. So we feel like the cool down over here throughout time, it's going to get easier. But you actually want it like this, where you're kind of in your training phase and then that you're training for a potential marathon into the future. And then we deal with it when it comes. But right now we got the problems here. Right now we're running it. It is what it is. Until we get back above that flip line is when we probably start to see this stuff stabilize a bit. You can see back month versus front month volatility. We're still below 1.0, which has led to, well, a bounce in the market. So surprise, surprise, nothing new there. We've been following that along very closely. Let's look at some of the signal charts. Okay, so we've been seeing a good market rally. However, now from a big strong move, we're outside of a weekly implied move. Some of the various Mag 7 stocks are too. Now, what are the signal charts reading? Well, if we take a look at the bullish percent index for technology, it's getting a little frothy. So what did we say down here? Go back to the video. Go back to the video when it was down and oversold here. What did we say could happen? What we stated that could happen is that the market could bounce from these areas. What happened? It bounced a little bit, okay? It was oversold. What happened? We put in, because what we like to look for is bullish divergences. A low, a lower low, and the bullish divergence took place. All right? So as this bullish divergence took place with a lower low reading here, and by the way, we called out how just extravagant of a low reading it actually was, are you shocked to see that the technology sector bounced the way it's bouncing right now? I'm not. It was a big move, and for those that prepared for it, got to relish in some of that. Now, the flip is happening. We're getting into an oversold condition. Perhaps it goes up a little bit higher. That'd be great. And perhaps we form a bearish divergence. Do something like this, right? And that right there could give us a signal to be cautious. Because if you look through history, look at the other bearish divergences that I've highlighted out. They were right here. They were right here. It led to some selling. It led to some selling. It led to flat tape and some selling right there too as well. So it's an important aspect to watch from a shorter term perspective that can give you just a little bit of an edge as far as when to position and when to get ready for a move. If you take a look at the NASDAQ McClellan oscillator down here, very, very frothy reading. We haven't seen a reading like this since really, I think it was the middle of July. So if you come over here, where was that? Yeah, right about the highs over here, pretty much. So we had the market kind of come in a little bit and rally up higher. And for whatever reason on this run up, it led to a kind of a blow off valve in the NASDAQ McClellan oscillator. And it ended up retracing significantly to a very overblown condition to the downside. Now, the most recent time that we talked about this was this very extended reading here. And if you just zoom this up, what did we do from that area? Well, we bounced. So to see the market potentially go higher and then come in a little bit and to reset itself and start getting lower readings, would you be shocked? The answer should be no. You shouldn't be shocked. Okay, so that's a totally normal to see. You can look at the NYSE-McClellan oscillator. This is the traditional calculation. We're getting a reading of near 250, and that is considered to be an oversold condition here of a reading over 250. Now, I love to look for divergences here too as well, and I've highlighted a bunch of on my screen, and every one that you see highlighted here I talked about on my videos, okay, including the bullish divergences that led to rallies, and the more recent bearish divergence was this one here that led to this gigantic sell-off. Even over here, right? Big sell-offs, and so forth down the list. So now what can we potentially watch for? Well, potentially, maybe, perhaps, a bearish divergence to set up in the near future. But right now, in the near term, things are getting a little frothy. How about from a percent of stocks above the 20-day moving average? We were talking about this when things were very oversold. The reason why I'm bringing it up now is because look at across the board. Boom, you're seeing a big boost in energy about the percent of stocks in each of these index products that are above their 20-day moving average. So what does this tell you? It tells you that, one, you're getting good breadth into the market. Okay, that's one thing, like the 1500 here, big move up. You got the S&P 100s, Dow Jones, NASDAQ, all these different index products. The NASDAQ composites are really cranking right here. But it also means that we can start to look for oversold conditions, which is typically in and around the 80%, and things can get kind of frothy from that standpoint. So another element to kind of just add into the mix. We talked about the put to call ratio and how kind of crossing through 1.0 to 0.95 is a bullish sign for these markets, right? When you're below 0.8 on the 10-day moving average of the put to call ratio, you kind of want to be a little cautious, especially when you start to cross back above it. And that's why we talked about the potential for a bull trap over here. One of the many reasons, and the market did end up selling off. Then we got to a pretty frothy reading and we came back in and the market is kind of rallying on that current move. If you pair this put to call ratio with the skew we talked about in the last video and many others, I just want to call out that skew has been coming off, and that's been a good sign to see. It's like just telling us that, hey, the hedging activity is coming off here is, I guess, one way that you can just really read into that quickly. And then we had the put to call ratio coming in here too as well. Typically, when you get these like frothy readings, right? This frothy readings up in here, and it's paired with a skew that's been coming off, it's marked bottoms in the market. Like, for example, the pandemic, the 2022 bear market. This one, we didn't quite get a very, very frothy reading of 1.2, but for whatever reason, if this starts to turn back around and this comes back down to 115 at some point, that's what we can potentially look for if actually a low is breached by any means, or if our main area that we're watching in the S&P 500 is breached. Because this thing can obviously come in and then start to turn back around. That's totally normal action. Or if it starts getting back over here and the market rallies further because maybe CTAs enter in, vol control funds, right, stabilize themselves, and we get a big rally that the people didn't really underestimate the power of what a rally can look like. And then all of a sudden we start to get underneath these levels, and then skew starts to turn back up again, perhaps, right? It could be setting up for another turnaround. But right now, right, we got to work with what we got. If you look at the old fool indicator, this is looking at the NASDAQ divided into the put to call ratio with some moving averages here to give us an idea of crossovers. It crossed over right at around this point. That's a sell signal. And you can see we've followed through to the downside. I'm just calling out right now, it's still on a sell signal. And these are a very laggy indicator, right? We got a sell signal here. It sold off and then it rallied up to like basically another high right here and then continued off as it kept on trending downwards. So even a big rally here, I will continue to watch this because even if it comes up, but still remains to be bearish, that could be a warning sign in of itself there too as well, despite it being obviously a lagging indicator. That we talked about a lot on today's episode, everybody. Hope it gave you some insights into the levels that I'm watching, looking for consolidations. I'm still very vigilant that volatility is rearing its ugly head here, that we're in backwardation, that we're under the gamma flip line, and things are getting better, but the market still got to prove itself. And we're on the cusp of that. We're on the cusp of that. So let's see if the bulls can pull through or if the bears are going to rear their ugly heads back into the game. See you later.